Man hör dich nicht, Silvan.
Okay, han tog mein Signal bei mir. We can't hear you. Ooh, technical difficulties.
Can you hear me now?
Yes.
Okay. So sorry for the 5 minutes delay. It was due to my technical incapabilities, but happy Tuesday and a very well welcome to this live stream, to the webinar today. We're going to talk about how much money you should raise for your Series A or Series B, and we want to focus on the investor perspective. And we have two amazing guests here. Of course, Laurent is back here from Holycoat, but also Ariana from Dart Ventures. And I'm going to start with you right away with the first question, Ariana. You're the managing partner at Dart Ventures. You're a San Francisco-based VC fund helping European companies break into the US market. And you've been working together with Sophie for about 5 years now, I think. She's also a resident guest on the Swisspreneur show and webinars, etc. So I wonder, what makes the two of you a strong and a great team?
Yeah, I love that question. Thank you. Sophie Lamparter is who I co-founded Dart with, and we've actually been collaborating for 7 years already, 5 years investing together. And I think what makes us a great combo is that we're very different. We have really complementary skills and tasks and things we like. She is much more extroverted than I am. She loves to network, to be out there. She's the one with the big vision. I'm great at execution and strategy and thinking things through. And so, especially when we started and it was just the two of us, it was really helpful to have different skills and different likes. But where we do come together is on values. We are 100% aligned on the things that are important to us, like transparency and trust. And I think that's also what makes our collaboration work well. We're quite honest with each other. Everything's open. And that's been working really well.
I think that's the perfect summary of a great team. Shared values and complementary skill set. Amazing. Laurent, over to you. I mean, by now, and also already before, everyone knows who you are. They probably also follow you on LinkedIn, I assume. So recently you mentioned that the Swiss startup ecosystem is still in a recession as of 2024. How do you think the companies, and especially the startups, will adapt in or during that recession?
That's a good start. Always sharing the positive news, Silvan. Yeah, I honestly believe that it's still the case, unfortunately, especially in Switzerland. I feel we're a bit lagging behind. You know, US was hit with the startup crisis 2 years ago. So was Berlin and London. I think a lot of those places have recovered by now quite strongly. Whereas Switzerland, I still see that, you know, we're still in a decline in most cases. So what I'm seeing a lot is companies actually going international, going to the US earlier, trying to hit Germany or UK earlier, actually going for investors from those markets even earlier. So yeah, I think it's a bit of a brain drain, not in the sense that the companies leave the country necessarily. There, maybe Ariana knows more about it than me, but definitely in terms of which markets that they're focused on. It's much more globalized.
So let's dive into the focus topic of today after these two quick intro questions. So we want to talk about how much should I raise in a Series A or Series B and focus on the investor's perspective. So let's say we achieved product market fit. We have a sales team in place. We have a product that is scaling, but now we need some funding. Last time, Laurent, we discussed fundraising from a founder perspective. So let's switch the gear here and focus on the investor perspective. And Ariana, let's dive into the sort of the get-go here. What is the expected range of a Series A round size in today's market? Because I know that also quite shifted a bit over the past few years.
Yeah, so we have the Startup Radar, which is great at providing us the numbers, and 5 to 15 million, I would say, is the range. And that's quite a big range, you'd say. I think the reason why it's such a big range is because some of the rounds have gotten smaller. A lot of startups are trying to raise just what they need to hit the next milestone. There's a lot more bridge or pre-Series A rounds, which is what I think has kind of widened this range. So what we're seeing is somewhere between 5 and 15 with some outliers, 20 plus.
Got it. And Laurent, how does that look for a Series B? Is that a similar range that we're talking about here?
It's actually much bigger, I would say. So the data that I dug up on it is that the average Series B round is around 15 millions, but the top 10% raise more than 60 millions. So you can see that the gap widens massively further down that road. And I think it just continues afterwards also with the Series C, that those ranges start increasing ever more.
Yeah, it's really sort of the differentiation between, are you going to build a big or a really, really big company? And you also need massively more funding for that. Ariana, when you take on investors, one of the first things that we often talk to from the founder perspective is, okay, I need to give up money, and also I need to give up shares for the money that I want to get in, so I get diluted. What percentage of equity should you expect to give up in a Series A as a founder? Because here you really have the investor perspective. So you could also say, hey, in a Series A, an investor wants X%. But what is sort of the dilution to calculate with for Series A funding round?
Yeah, you would typically expect roughly 20%. I'd say it's somewhere between 15 and 25. It's been more between 20 and 25, I think, in the most recent years. And I think that's also the reason, again, for smaller rounds, right? Taking in less capital before any major milestone will allow you to keep the valuation low now, but then raise a smaller amount at a higher valuation later, protecting your own equity. So the times of really big rounds and bloat are definitely over.
So doing smaller rounds helps you to protect dilution. Is there anything else that you see from also an investor perspective that founders could do to minimize their dilution?
Non-dilutive funding. We're seeing, focus on grants increase when VC funding becomes a bit more difficult, or like revenue-based financing becoming more creative in the types of financing you consider. And then the one thing that I find often missing when thinking about the round is, how will what I decide today, or the terms that I agree on today, impact my future rounds? And that's something to keep in mind. You don't have to just make it work in today's round, but how will the Series B or C investor look at the cap table and look at everything that's been done before?
Maybe we can dive into this a bit more. Like, what are some mistakes that you see founders make in that sense, or that you as an investor then say, well, with this, it will be very, very difficult to raise additional rounds, or you have to do a big cleanup? What are the pitfalls here that you just mentioned?
I'll maybe give you a concrete example from one of our portfolio companies that had the option to occur an interesting type of debt. So they had a partner that was paying a certain rate for a product, and it was clear that that rate is going to go down and they're going to have to pay something back. And so they were thinking about that early on, and they called and they said, hey, if we start a financing round with about 800K in debt, if we start a Series A round of, let's say, 6 million or 7 million, but the first thing we need to do is use a portion of debt to pay back this debt, will this have a negative impact? And yes, it will. It obviously depends on what's the ratio of debts to the round that you just raised. But those are the things that I suggest anytime you're getting ready to raise a round. Talk to your existing investors, like utilize them, walk it through with them what your plan is. Talk to them about the things you're worried about, like that one, like, could this impact me negatively? What should we do about it? So utilize your friendly investors, utilize who you already have on the cap table to gain these things through, and set yourself up with a good strategy.
Yeah, because you're already playing on the same team, so you want to see the company succeeds. That's very helpful. And another follow-up question on that is, often early on, founders are very worried about the cap table and having it as small or as lean as possible. How big of a role does that play for the Series A or Series B rounds? Is that still something that can really mess up the whole round if you don't have a clean cap table? Or what role does the cap table and the allocation play in that sense from an investor perspective?
An important role. We've seen rounds fall apart because of simply expressed cap table issues. For example, having a lot of individual small investors on a cap table, like reaching a Series A with a cap table that already has 80 individual people, potentially with different terms, that will impact your ability to raise the next round. For a couple of reasons. One is a messy cap table makes decision-making more difficult. But the other is also that with every new round you go into, you want the existing shareholder pool to participate, right? An A investor is going to ask you how much of the existing shareholders are participating and what are they contributing. And if you have, for example, 60 angels on your cap table that are no longer able to participate in an A round because the ticket size is too big for them, the signaling that you're sending to the new investor could make it a bit more difficult. So you have to always explain, oh, these are, they have limited pockets and they've reached their abilities.
One of the good things you can do there, sorry, Sylvain, one of the good things you can obviously do there is pooling as many of those investors as you can early on, because doing that later on is very difficult to achieve. It's still possible, but try to pool everyone from the start that is not really serious on your cap table. If you achieve that, you should be fine from that perspective.
Yeah, good point.
How do you pool them? Just out of curiosity, do you pool them and say, hey, we still have them on the cap table, but we pool them that there's just one person representing the whole pool? Or do you pool them in a hard way that they don't even show up on the cap table anymore? Because there are different ways to achieve that, right? What is the best practice that you see?
Maybe Ariana knows more about that, because I've seen a couple of those cases, but in the majority of the cases, everyone that is not supposed to be, for their name or their expertise on the cap table is pooled into a pool where you're not showing up. You still have to disclose who is in this pool to the investors afterwards, but there's just one representative on the cap table.
Yeah, a couple of different ways. Often we see friends and family represented by one of the founders. So you'll see share class X represented by CEO, and then you can of course see who's behind it. Sometimes we see syndicates, a plug for in your direction, right? Pooling angel investors through a syndicate. Also Omnium, and full disclosure, also a plug because I'm on the board there. They basically offer digital capital increase where you also pool all of your investors and tokenize them so you can easily deal with a diverse cap table. So there's different ways of achieving that, but Lauren's point is really important. You got to think about that at the seed stage already, not when you're already at an A round, because it becomes so much more complicated, and then you need everybody's buying, and you need to reach all these people and get them to sign stuff, and that's just a pain in the butt.
It is, yeah. We've also been there with our first startup. We were way lower than 80, but still it was a big pain in that sense. Laurent, the next topic I want to talk about is the company valuation. No matter what round you're raising, that's always sort of the hot topic or even the elephant in the room. So how do you assess your company's valuation at the Series A or Series B stage?
It's not an exact science. Let's start there. Different investors, different markets, different growth rates, different business lines have different valuations. What I'm trying, when I'm looking at a company, let's say in the Series A, what I'm trying to look at first still is the team, because I think that's still very important at that stage. So how diverse are they? How much industry know-how do they have, etc. And then I look at the more hard facts, let's say ARR, churn rates, net revenue retention, growth rates. That's sort of what I try to look at in the Series A. For the Series B, where honestly, I'm not the guy that is investing anymore. That's out of my reach usually. But there, I think what the team part moves much further down, right? So it's much more, also Kai from Oviva told us that last time, it's much more about the hard facts, really, like ARR, growth rates, how close to profitability are you? For SaaS businesses, it's usually the rule of 40 that comes into the play. And then afterwards, it's like the team, basically. So yeah, that's how I look at it. But I'm not as professional as Ariana.
You meant, Laurent, you're not investing in Series B rounds yet. That's yet to come, I imagine.
Let's hope so.
Okay, let's move on with that topic. So the science, there's no real science behind it, it's more art. And from an investor perspective, Arianna, just curiosity, how do you go about that valuation? Because it is not a science, it's art. Do you just sort of blend that all in what Laurent just said, or do you apply a certain specific valuation concept or formula or anything of that sort to try to bring everything together?
I think that was one of my biggest surprises when I started in investing. I was first spending too much time trying to use some kind of scientific method to come up with evaluations. But you know what? We invest in early stage, pre-seed and seed.
Yeah.
And there's, I think, two main factors. And we're still fully focused on the team because Laurent is right. The later stage you go, the less that becomes a focus. But for us, that's a big focus. And then it's just, is it a product market fit? And then you're, a founder market fit. And then you're looking at comparables. What were the other 5-6 startups you saw in that space coming out of ETH? Where were their valuations? And how much ownership does the founding team still have? So you want to be, again, within that balance of those 15, 20, maybe 25%. But it's more getting that in a balance than like evaluating technology and pipeline and all of that.
But if I understand that correct, it's also a bit of a negotiation game, basically. And whoever has a bit more power or wiggle room in that sense, they will probably get a bit of a better deal. That's pretty much it. And then for everything else, you just have to do your due diligence to ensure that you don't discover any red flags that would go against investing in that company.
Yeah, but to be honest, the times of a startup having 3 or 4 term sheets to choose from are not the current times. So I feel like there's much less negotiation going on valuation, and more negotiation going on all these other terms like liquidation preference and like founders vesting and all these other terms that are often neglected by founders but can have a huge impact later on. Like valuation is just a small portion of the game.
Definitely. Maybe we can talk about these additional terms that are so important as well, because liquidation preference, it's probably one that often gets overlooked, especially by first-time founders, but then bites you back in your butt when you actually have an exit and then you see, oh, cool, we sell the company for 20 million or 50 million. But actually, because of the liquidation preference, the investors get their money back first, multiple times, maybe even, before you as a founders get anything. So maybe you even end up without getting any money out of a good deal on paper. So tell us a bit more about the rationale of the investors behind it and what makes a good investor in these terms and what makes a bad investor, if I can call it that way.
I mean, it's all about protecting certain things. Like in the specific case of liquidation preference, for example, if you have a startup that is struggling to raise and they find an investor that has a liquidation preference of 2x participating, that would mean that, so let's say the startup is valued at 20 million and it gets sold for 20 million. Now this investor is first going to get his money back, let's say the 2 million that they invested, and then they're going to get 2x of the profits. And if the sale is a small one, what's going to happen is they're in the end going to end up with all or with the majority of the profits, making it so that there's nothing left for the founders, but also for the early stage investors. So as an early stage investor, this is something that we sometimes see, right? That the terms change so much that if the company is not a big success, it's going to be a write-up for us, even in the case of an exit. And whatever affects early stage investors, then in the same turn affects the founders. They can have a successful exit and not have a successful exit in financial terms, personally.
And I think those things also roll over, right? So if, let's say, the Series A investor asks for 2 times liquidation preference, the Series B investor will definitely also ask for that. So yeah, you will end up with every round that you do, you will end up deeper in this hole where you're just not going to get out of anymore unless you're a unicorn success, right? Other than that, you as a founder will walk away with very little. So yeah, as Arianna said, I think valuation is just a small part. There's a lot of things that are like liquidation preferences that are much more tricky as a founder that you need to look at. And I think, coming from this era, let's say 2011, 12 to 21, 10 years of growth and always more investment into startups, I was there. I was doing these mistakes, right? And thinking that, yeah, this is not going to be happening to me. We're not going to be in that situation. Luckily, we did not have these really strong liquidation preferences, but we had some. For us, it turned out well. But everyone that is now trying to raise from the old world basically to the post 21 world, they're going to be in a very, very tough situation based on these multiples, valuations, and liquidation preferences that they have. So I think today founders are much more aware of this than they were 4 or 5 years ago when everything looked more rosy and shiny.
Mhm.
Which is also a good thing. It's sort of maturing up the ecosystem a bit. Arianna, is a 1x liquidation preference, so the investor get their money back, but not more than that first. Is that still something that is common, or is that getting more and more difficult because the investors just have more power these days?
We're definitely seeing more non-founder friendly terms than we've seen in, let's say, 2021. And we've looked at one term sheet one of our startups received with a 2.5x liquidation preference, with participating with restarting of the founders vesting, and the founders have been added already at 7 years almost. With some payback provisions where, like, if some milestones are not reached, the company would pay back 2 times the investment that they've gotten. So
Wow.
this investor basically, and this is $1 billion fund, like, they're not new to this game. They know exactly what they're doing. And they basically wrote a term sheet that ensures that they get at least their investment back, and usually with an upside, no matter what happens to the company. And when you play out the different scenarios, we had to come to the conclusion together with the founders that it did not make sense to take this investment at all, because there was no scenario unless like a huge exit that would benefit early investors or founders.
Yeah, talking about the risk profile, right? The risk reward profile in that sense. If you then as a founding team or early stage investor only face the potential downsides, but you have only a tiny bit of upside in the best case scenario, you're like, why would we do this? Like, you could just stop there and walk away with nothing, basically. It's completely wrong incentivized.
And it's also going to make it difficult to raise your next round, because again, the next round investors are going to look at that the same way I'm looking at that and say, well, either I have to come up with crazy provisions to protect myself, or this doesn't make any sense.
That's crazy. And Laurent, Arianna mentioned before that the times have changed a bit. So I wonder, in that sense, do we also see more that it's important to now have a clear path to profitability versus aggressive growth that might have been the case before COVID or during COVID?
I see Arianna nodding. So if I say no now, I'm in trouble. No, I'm kidding. Obviously, yes, that's the case. I mean, there's 2 things. One, I saw quite a big movement in the last couple of years towards more bootstrapping your company, right? To really be profitable from the offset and not having to go on to such crazy terms. That's the first part. And yes, secondly, it is much more important now to have a clear path to profitability. I see a lot of founders actually talking about, I'm just going to raise 1 round, and that will enable us to become profitable and then grow from there. Maybe we grow slower, like a bootstrap company usually, but at least we have our fate in our own hands. So yeah, that has become a lot more relevant, unless you're in deep tech and AI, which in my opinion currently is still, the hot markets where everybody's trying to invest into. And there it's still the same thing, right? It's a land grabbing exercise. Who can grow the fastest and secure the most important clients and deals out there in the market. So a lot of them, not all of them obviously, but a lot of them there are still really growth driven. But any other area right now is much more about becoming profitable and showing that you can become profitable quite soon.
I love this just raising 1 round strategy. I think that's a new, very attractive path for early stage founders. Arianna, we already talked about the term sheet that can be a deal breaker, but what are other deal breakers for you when it comes to looking at the potential investment? Now, thinking about, I know it's not your focus, but think about Series A or Series B. What could be potential deal breakers from an investor's perspective?
I think to me, the biggest deal breaker, regardless of round, is like lack of transparency or dishonesty. Right? It's obviously important that when you're pitching, you're highlighting the positive aspects of everything, and that you're positive and that you don't seem desperate even when things are tough. But when I dig into a data room and dig into your strategy and all of that, I should not find a very different picture than what was pitched. So it's a fine line of being positive and highlighting certain aspects without becoming dishonest or deceptive. And then I don't know if this is a personal thing or not, but a sort of a messy or unorganized process always worries me a little bit. Like I have chaotic days. We all have days where we're just not 100%. So there's always like, okay, let's have a second call and see if they got their ish together a bit better. But if the whole process is unorganized or chaotic, then I worry if that transfers into all aspects of the company. Will you be able to sell good? Will you follow up with your prospects? Will and so that's something that I find common across all of them, that sometimes like turns off the excitement. And if we lose excitement during due diligence process, that's a strong signal that we should not continue.
Yeah, I fully second that. And I think closely linked to that is also communication. We always see that with syndicate applications for the Swisspreneur Syndicate, and there, if you don't feel that there's a good communication or the process is messy, as you just described, it's not gonna, like, it just turns you off big time. You think this will never work, basically. Hopefully you're wrong, but it's a big turnoff. One thing in the process I also want to talk to you about, because sometimes the VCs give us positive signals. They say, yeah, we're interested, but they're actually not really interested. They're just being polite. And sometimes it's difficult to tell the difference as a founder. So first of all, why do VCs sometimes, sort of keep the door open, although they are not interested? And B, how can founders better recognize that to differentiate where they should focus their time, where it's worth their time, and where it's just a loss and they better cut the communication or the potential deal?
To your first question, why do we keep the door open even though we're not interested? I think it's twofold. On one hand, VCs really operate on FOMO, right? Fear of missing out. So there's always like an underlying, did we make the right decision here? Is there something that we're not seeing? Especially when, for me at least, when I see other funds that I have a huge amount of respect, when I like see that they're in, and then I'm like, yeah, but I'm not convinced. Am I missing? Am I the one that's missing something? So you'll still take the call because you want to make sure you're not missing anything. That's maybe the positive aspect. The less positive aspect is there is a lot of funds that are not making investments at the moment because they lack liquidity. But you can't say that, because if you say that, then your deal flow breaks in. So the moment you are liquid again, you don't have a good pipeline. So they keep taking calls to, keep up to date, to keep the ecosystem alive, to not be basically forgotten. So it's okay to ask investors, are you actively deploying capital right now? That's totally a fair question. It's when founders are struggling to raise, you can assume that it's also not the easiest for VCs to raise a fund. And like Founderful just raised 140 million, big shout out to them. But that's really, I don't think people understand how difficult it actually is to do, especially in Switzerland. Like raising a seed fund for 140 million is huge and really difficult. And so there is a lot of VCs that are struggling with their fundraise. And that may be the reason why they're not acting at the moment. You can also always ask for process and timeline. Like, how does your decision making work? What can I expect from you in this journey? That will also give you an indication how long should this whole thing take, and if that works for you. And lastly, ask directly. I often have founders ask me at the end of the call, what do you think? Is this something that you're interested in? Which aspect is appealing to you? Or why does this not fit your thesis? And you put them a bit on the spot, but it will give you an indicator. And then also how fast they're responding, right? If you have a call and then don't hear from them again 2 weeks, and then maybe they schedule something for next month, then they're probably not as excited as if they like research the market in between and schedule the next call, and you can see that they're engaging with you.
I like that. I love the, sorry, Sylvain, I love the ask directly that you said, because I think too many founders actually really miss out on that. It's the last 2 minutes of the call that really can differentiate whether this is the right investor for you. Just asking directly, why are you interested? What is appealing to you? are you willing to take the next step and book a call right now? Just ask those questions that you probably feel a little bit uncomfortable with, but it gives you all the signals you need. So yeah, love that. Sorry, Simon.
And it's just like sales, right? You have to ask for the close. So here you have to ask for at least another meeting or for the money eventually. Otherwise, you're not going to close. So I really like that spirit and really putting you as a founder in the driver's seat to push forward and to own the process. That's also what you probably want to see as investor, I assume, Mariana.
Yeah. Assertiveness can sometimes be annoying, but it's for me, it's a signal that somebody has drive, which is needed to scale a startup.
And you mentioned the economic climate. That's also a sort of a big role, not only on the startups, but also on the funds itself. So Founderful pulled that off very, very impressively. And I just wonder, for you, from the investor perspective, what role does the current economic climate play? Because it can make it harder or easier for you, depending on the interest rates, etc., to raise a fund and to also deploy money then after all. So what role does the economic climate play for you as an investor yourself?
On the fundraising side, it plays a really big role because on one hand, for example, right now there's liquidity missing in the entire ecosystem, right? When there is no IPOs or exits, then LPs are not getting their money back. If they're not getting their money back, they don't have money to invest in the next round of funds, etc. So this is kind of a trickle down or not trickle down issue. From a topic perspective, like if you're raising an AI fund now, it's obviously a bit easier. We at Dart invest in health and climate tech, not just because we're personally deeply convinced that this is something that is necessary, but also because we see both verticals as kind of future-proof. Like both health and climate are gonna remain important topic no matter what's happening. I think cybersecurity, but next to AI, is doing well. Maybe also not for the reasons that I'm excited about, but there are some areas that are growing and that they're doing well, and other areas like fintech, etc., or ed tech that are struggling much more.
Makes sense. Yeah, it really also depends on the vertical and the sector that you're active in. Laurent, in that sense, we already talked a bit about the importance of the team getting less and less important, and sort of the hard facts, your KPIs more important as you progress further down the different fundraising rounds. But I wonder about the role of technology and innovation in the company versus the market execution. What role do they play along the sort of growth funding route?
Yeah, also very difficult to frame it without being too simplistic. But I would say that at the end of the day, market execution is really what drives the value of the company, right? So you need to have a great idea, you need to have good technology, you need to have good product, but it's so often not the first one to the market that wins the market, but the second or third one that is actually doing it just good enough, but executing like hell. So market execution is definitely the more important thing. So I think it's really sort of like you have a great idea, you build a great marketing and sales on top of that, and eventually your product is not just mediocre, but you also start building a great product so that you have the long-term retention. That's usually what makes companies successful. Yes, there are these outliers that build a fantastic, hyped product from the start and they just grow massively. But I would say 90% of companies are actually, you have a great idea, you're becoming an expert at sales and marketing and really driving market execution. And through that, you're building a better and better and better product that over the long term just has a moat that is undefeatable, hopefully.
I like that perspective because it also shows first you need to identify the problem, but then you can make money off that problem that you solve. And with that money, you can reinvest in more innovation. I think that's exactly the right cycle that it will then hopefully allow you to make even more money and reinvest or get acquired or whatever it is. So I like the 3 steps sort of that you just mentioned here.
Yeah, and I think a lot of them actually fail at the last step in the end, because you're so good at you become great at sales and marketing, and you build a great team around that, and you start scaling, and your product has deficiencies, but you keep scaling on the same technology, on the same base, and then a lot of them cannot make that jump, and they just plateau out at some point. So I think the last one is also a very difficult one, but yeah, it's the third one, not the first and not the second one.
I mean, there, just on this last topic, you could probably do a 2-hour podcast, because this is probably then where it differentiates whether you're going to be an SME or sort of an okay company, or if you're becoming really, really huge. Because if you can do that innovation cycle over and over again, you're sort of becoming unstoppable. I wonder, in that sense, Arianna, you also have competitors at one point, right? Maybe not so much in the beginning because you're doing it in a unique way, or you have substitutes, but at least once you enter the growth stage, it's very likely that you have many other companies doing something similar to you or even identical. What role does competition and also the positioning and the differentiation play from an investor's perspective? Is that something that you really care about, or is it just simply not that important?
No, it is something that we really care about. And again, for my perspective, we often look at the US competitive landscape a bit more than the European one. And specifically, we look at the maturity and funding of the competitive landscape. So even if there is not a ton of competitors, if they're really well funded already, right? If they're already past their Series B, but you're a seed stage company, it's questionable how much space you'll be able to gain, or how much market share you'll be able to gain. So it's a mix of maturity and funding of the competition compared to the market size and growth of the market. And then another aspect, of course, that's really important is exit potential. That's one thing that startups often don't think about, what a VC needs in order to be successful, and it's what they call fund returners. And so does this company in this space with this team have the potential to return the funds, basically, is one of the questions. And we invest in A rounds only as a follow-on, so it's never our first ticket. And so for us, it's a lot about the team's ability to execute and the traction they're gaining since our first investment. So there we're more focused on, okay, we know what your plan is, we know what your KPIs are, and how well are you actually at executing.
Amazing. Makes a ton of sense. And I wonder if, Arianna, you have to give a tip to a founder preparing a Series A round now. What sort of recommendations or sort of good advice would you give them to say, hey, that's a good starting point. Here's my top advice for you to get ready for the Series A funding?
It's not a very unique one. You all probably heard it many times before, but it's invest time in knowing who your ideal investors are. Don't spray and pray. You can shoot out 500 emails to a huge list of investors and have a very low success rate, or you can reach out to 40 and have a really high success rate. Like, those are arbitrary numbers, but my point is, research, first of all, what is the right investor profile, and then who are those people, and then for your top 8 to 10%, have a personalized approach. Look at what they've invested in before, reference that investment. In the first line of the email, it should be clear to the recipient why they should continue reading. And we get such amount of spam. Like, I frequently get, on a weekly basis, get emails about startups that are raising C rounds of like 60 million when I'm running a 20 million fund. That clearly does not match. But because there's so many who just blast out every single investor there is in the universe, it makes it then more difficult for us to screen properly. So the earlier you can tell me why I should continue reading and why it's a match, the higher the success. And then also warm intros. Again, utilize your current investors to open doors to their peers. We all network with each other, especially here in Switzerland. It's such a small ecosystem. We have the Swiss CC events where we meet up twice a year. We have a WhatsApp group with like 400 VCs in there. We are in constant exchange. So utilize your investors.
Very well said. And it's really quality over quantity in that sense.
Yeah.
Laurent, once we have the round closed, let's say, okay, we made a deal, everything went through, we were like well prepared and the deal happened. Who is more stressed out after the close of the round, the investor or the founders?
Very clearly the founders, in my opinion, right? Because you're the ones now, you've promised them the world. Now go and show that you can actually deliver that, right? So now you need to get those 100% growth rates, or you need to get to that next inflection point or whatever. I think the best investors I've worked with are the ones that are quite hard in negotiations with you. But the moment they sign the term sheet, they turn around and they're really like your partner and start negotiating for you with the next round and opening doors to you. So I think for the investor, it's really, if you really want to get in on a deal, you're stressed until you're in on the deal. And then after that, usually you're not that stressed anymore, unless the company goes into, a bad spot. But also there, I think as a founder, you have to be very realistic. 9 out of 10 investors will drop you if you're not starting to hit your targets. Not in a bad sense, it's just that's how funds is set up. They're looking for the ones that are fund returners at the end of the day. And if you're not a fund returner, they might take a couple of your calls still. They might answer to some of your emails, but they're probably not going to help you really grow that massively anymore. So it is down to you performing in the next 6 to 12 months after you've signed that investor. So yes, the stress is very firmly on the founder.
Very clear message. And Ariana, as part of that post-closing communication is also the reporting, right? So I just wonder, what is sort of the best practice? Like, how often do you expect a reporting from your portfolio companies, and what key information are you looking for in there?
Yeah, I'm a big fan of the quick and dirty monthly email updates, like major updates, highlights, lowlights, KPI tracking, headcount, runway, sometimes some industry news that are relevant, and asks. Include asks, like if there's something you need introductions, you need door openers, you need access to an event, whatever it is, put that in your monthly email, blast that to your investors. They may be able to help you, and the effort on your side is quite low. What we also have some portfolio companies that are doing quarterly updates where they send like a slide deck and then do a call with it. That's also great, scheduling 45 to 60 minutes every 3 months to get all your shareholders all your investors on a call, and that gives them the ability to interact and ask questions. But don't keep the same format, and don't make it something that takes you hours and hours and hours. Like, it's fine to keep the same bullet form structure in an email and send that every 30 days. It doesn't have to be some fancy dashboard or slideshow or whatnot.
So here, keep it simple but valuable in that sense.
Yes.
Laurent,
yes.
You wanted to add something?
Yeah, ship bad news early. I think that's especially why you should have these monthly emails, right? Because you will be able to tell the investors quite on a regular basis if something is not going in the right direction. Mm-hmm. I see that over and over and over again, and I don't understand the thinking behind it. Founders not communicating to the investors for 6 months and then coming, guys, we're running out of money. We need around 3 months or 2 months from now. What's the thinking process behind such behavior? So be clear about it. Be very honest and direct and say, look, we lost this big client, and this will reduce our run rate by 6 to 8 months. We need to start doing something about it now, rather than waiting to the last minute. That's the clearest path of not getting funded again in the future.
Yeah, you lose all the trust basically of everyone involved, and that's the most precious thing that you have if you want to motivate your investors to follow on.
To add something, because that's such a good point, to come back to your question about pitfalls. If somebody from the team, from the core team, is leaving, make that clear. Try to replace that person before you start around. But what I've seen happen once or twice, and it leaves a really bad taste in an investor's mouth, is if you invest in a team and then right after you close that investment, like the CTO announces that he's leaving, you kind of assume that he or she knew that before, and then you feel deceived. So that happens. Teams fall apart, or somebody decides to leave. But address that early on. Don't inform the investor once the deal is done.
That's a good point. Also, again, for the long-term trust in that relationship, basically.
Yeah.
Hey, to wrap up the conversation today, I also want to ask you some rapid fire questions, just short questions, and you have to answer in 1 sentence or less. Are you ready? Let's start with Ariana. What's the most overused buzzword in pitches today?
AI.
Of course, I was expecting that. Laurent, what's one piece of advice you'd give to founders before pitching to investors?
Well, simple, train, train, train. You would never play a professional tennis match without training lots and lots of hours before that. So it's the same here.
Great. And Ariana, what's your preferred method for initial meetings, in person or virtual, and why?
For the very first meeting, virtual, for one reason, not everybody is in Zurich. And so this way it levels the playing field. And also it's just more efficient.
Got it.
I do
And
want to meet them later on, but for the very first
Fair
one,
enough. Yeah. I was just asking about the first. Yeah. Laurent, I know we already talked about that. If you had to choose profitability or growth,
Profitability with adequate growth.
I see. So profitable growth, basically.
Yes.
I see. You want to make the impossible possible almost in the startup world.
Yes. But yeah, lean towards profitability, please.
Got it. Ariana, what's a common misconception that founders have about VCs?
Underestimating all the factors that go into investment decisions. Like sometimes there's an investment thesis that may be restrictive, and there's multiple points we need to hit, like stakes, the capital needed, return, etc. Just because it's a thesis fits on surface doesn't mean that it's going to go anywhere.
Fair point. Laurent, what's your favorite way to unwind after a day full of meetings or podcast recordings?
I'm not doing that many podcast recordings, but well, if everything would be perfect, a run with good music for 30, 40 minutes. In reality, usually it's playing with my kids something. Yeah.
Nice. Ariana, the biggest red flag in due diligence that would make you walk away from a deal?
I think I already said it, dishonesty, or not operating in good faith.
And the last question I want to ask to both of you, just because there has been a lot of discussions recently, Europe or the United States. Let's start with Laurent and then with Ariana.
To live, I still prefer Europe. For business, clearly US. That's also why Holy Code is now expanding into the US.
Ariana?
Say definitely Europe. This is a hard question after the election. I live here by choice. I've lived in the US for a long time. I'm here by choice. And when it comes to doing business, sure, from an opportunity perspective, yes. From a protection perspective, not necessarily.
No, there's no clear winner. I see. It's really both have their pros and cons. Let's leave it at that.
Yeah.
Laurent, Ariana, thank you so much for your time today. It was a pleasure talking to you and all the insights and really great takeaways that you shared. Thank you so much for your time and all the best to both of you.
Thanks for having us.
Thanks for having me.